per BMO Economics, 1.8 million Canadian mortgages are up for renewal in 2026, with a big peak in June. Some locked at 2% in 2021, but those ultra-low rates are gone. A massive payment shock is coming, even after 9 Bank of Canada rate cuts, which directly impact variable mortgages. The bond market and fixed mortgage rates are hovering around 4%. That is a big jump in monthly payments for many. Will millions lose their homes? Is this the massive inventory flood buyers have been waiting for? I'm breaking down the data to see if 2026 is a housing crash and buyers' biggest opportunity. Should you buy in 2026? And what should sellers do? Let's dive in. Based on the latest figures, GTA's average price is down 6.4% in 2025. Sales are down 15.8%, and active listings are up 16%. Less sales, more inventory equals lower prices. With 2025 being the lowest sales in 25 years, there is downward pressure on home prices. There are 4 factors that drive housing prices. First, economic growth, also known as jobs growth. Second, population growth. Third, supply and demand. And fourth, interest rates. Let's take a look at each factor. For the economy and jobs, 2026 is a tale of 2 halves. First half will likely be status quo. The second half will be dependent on what happens with the upcoming negotiations of Canada, US, Mexico free trade. With respect to population growth, for the first time since 2020, Canada's population shrunk in the third quarter of 2025 by 76,000. Third, supply and demand, which is a hot topic. The demand side of the equation is driven by economic and population growth. Supply has been an issue for as long as I remember. The new development market has been completely frozen since 2023, and this will cause issues down the line in a couple more years. With respect to the fourth factor, mortgage interest rates, we all know money was pretty much free in 2020 and 2021. Let's take a look at an example of a homeowner who are renewing from 2%, which they got back in 2021, to today's mortgage rates, which are hovering around the 4%. All right, so let's take a look at this analysis that I've done. And we'll start on the very left column here. So in this case, the assumption was based on the following. This mortgage was taken out or set up in 2021. The mortgage balance at that time, 1 million. Obviously, everybody's case will be different. It could be 500,000, 750,000. But in this case, I used $1 million mortgage that was taken out in 2021 at 2% interest rates with a 25-year amortization. So at that time, that mortgage monthly payment was, and still is until it comes up for renewal, $4,235 a month, which puts the mortgage balance at maturity. So in 5 years time frame, in 2026, the balance would be $837,702. So they've built some equity. As you can see here, it's about $163,000 equity that was built over those 5 years. And that's the renewal mortgage balance in 2026. So in the next 3 columns, I ran 3 different scenarios with, you can see at the top, the mortgage balance is $837,702, which is taken from the maturity from the first column. And you can see that across the 3 scenarios here, case 1, 2, and 3. I assume the interest rates will be renewed at 4%. Now, keep in mind, people will have options in 2026, whether it's a 5-year fixed, a 3-year fixed, a variable mortgage. So there will be some options available to them at renewal. Yes, it is much higher from what they started with, but however, they'll have some options. So that rate could fluctuate slightly up or down depending on the product and the term. But in this case, I've used 4% as an interest rate for analysis purposes. So a couple things. First column is if the homeowners continue with the same amortization. So when they bought the house, it was 25 years. And now 5 years later, they should have 20 years remaining. So in this case, I continued with the 20-year amortization to pay off that mortgage in 25 years. The mortgage payment goes up to $5,062 from $4,235, which is an $827 jump based on increasing from 2% to 4% at renewal timeframe. Now, this is a big shock. It will stress some homeowners. However, there are options, like I mentioned, with different products, whether it's a 3-year fixed, a variable, that could ease the pain. The other thing that some homeowners might consider doing is restructuring the amortization. So you can see here, I've kept the interest rate the same at 4%, but they've gone back up to the original amortization of 25 years. It is not ideal. Obviously, you're going to pay more interest because now you're stretching the mortgage for another 5 years. But I wanted to show these numbers. And you can see here, the mortgage payment is $44.06, which is a $171 jump from the original $42.35. I believe this is manageable. If it's a worst case, homeowners have to restretch to 25 years. The payment difference is $171, which should be absorbable by most families across the board. And again, keep in mind, this is a large mortgage, which at renewal timeframe is $837,000. Right below that, what I've put is the mortgage balance and maturity. So going back to the second column, with a $5,062 monthly payment at 4%, 20-year amortization. In 5 years time frame, when this mortgage renews, the balance would be $685,843. In this third column, you can see that $729,252 is the mortgage balance at renewal. And again, it's higher because they've restretched the amortization to 25 years, which incurs more interest, and they don't pay down the mortgage as fast as if it was per the original amortization, which would have been $685. So you can see there's a good, you got 15 and another 30, $45,000 of extra cost that the homeowners would have to incur. But in this case, the mortgage payment shock is $171. The third case that I did is in case the homeowners, someone loses a job, there's only a single income earner in the household as opposed to two, and they're, in a position where they have to further stretch the amortization to 30 years, again, which is not ideal because now they've gone from 25 and instead of renewing 20, they've stretched for another 10 years. The payment drops to $39.83, which is a $252 savings compared to the original $42.35. However, you can see the mortgage balance at renewal at that time would be $757 from where they would have been at $685. So you got $57 and another $15. You're looking at $73,000 of extra cost incurred by the homeowners. So the reason I'm showing this is there are headlines in the media and online. However, I don't believe it will be that bad. Yes, there will be some homeowners who will be forced to sell, increasing the supply of homes for sale. But I do believe most homeowners are capitalized and they will have options to work with their lending institutions or banks to work the numbers. Because at the end of the day, if the banks or the lending institutions do not, work with the homeowners, and instead of forcing them to renew a 20 years amortization as opposed to work with them to 25, that could force potentially a large supply of homes for sale. And again, with Economics 101, as supply increases, that would, and keeping the demand the same or lower, that would put downward pressure on house or home prices. And that's not good for the banks because that would risk their equity position, because the last thing they want is to force power sale or foreclosure, depending on the province, and push the prices down to the point where there is not much equity or enough equity for them to sell the house and for the bank to get their money back. I believe there will be some homeowners who will be stressed. However, I do believe that the majority will be okay, because we got to remember too, from 2021 and 2020 and the first 2 months of 2022, there were homeowners who took variable mortgages. Some took short-term mortgages, as in 3 years or so, and some took the 5 years. So A lot of the variable mortgage holders felt the pain of the higher prime rate at the peak of 2023, and those homeowners adjusted and managed to absorb those payments. So they're coming down to a lower interest rate environment, which they should be okay. So there's a smaller portion of 5-year fixed homeowners who will be in this position. To summarize, I believe there will be some homes for sale because some owners will not be able to work the numbers, but I do not believe there will be a flood of supply that would be pushing prices significantly down further from the price drops we've experienced since the peak of spring 2022 to nowadays. What does this mean for buyers? More homes on the market. There will be more room to negotiate. Prices are going to be steady or slightly declining. Now, keep in mind that real estate market will behave based on submarkets. Toronto condo market will experience more downward pressure due to new supply of new projects completing and weak demand. For detached and semi-detached properties in the city, it will depend on condition, price, and location. Some will sell fast, some will take longer to negotiate and get a deal done. Every neighborhood in Toronto behaves a bit differently. If you've been renting or feeling priced out, 2026 might be your moment to get into your first home. What about sellers? This year calls for logic and reason. Emotions will punish sellers. Listing price needs to be sharp, staging top-notch, marketing professional, and the home should be move-in ready. Flexibility will be key in negotiations. You can still get a good sale, but you have to work with the market conditions. If you're new here, I help people navigate the Toronto real estate market. If you want the latest news and honest advice without the sales pitch, hit the subscribe and like button so this information can get to more people. If you want help with your home selling or buying journey, reach out via the link in the description below. Thanks for watching, and I'll see you in the next video.